So let's go through chapter 8, question 1. I do want to apologize in advance because I'm recording this on my phone, so if it looks a little foggy or shaky, apologize. So, question 1, I'm not going to read the whole question verbatim, but the gist of it is down under Boomerang is trying to invest in a project and they're trying to figure out if they're going to make any money, how much the difference between what they put in now and what they're going to get at the end of the project, if it's worth taking this project. And so the fixed asset investment is worth $1.8 million. They're thinking about it's going to take about 2 years to do this project. Depreciation is straight line. Um, it's going to generate $1.6 million with a cost of $652,000. Tax rate is 35%, and required rate of return is 9%. And so, if we try to look at this, I put a little explanation from page 248 of the text as far as what OCF is, operating cash flows, and also put a website that you can get a table for the present value initial factor annuity, because I looked in the book and I couldn't find a table in the book. So there's a website that you can go to for the table. And so if we go a little bit down to where and the question and the problem is asking how to calculate using the tax shield approach. And if you look at the text, there's about 3 ways to approach this. And so the tax shield approach says, so we're going to go in and take basically the sales, how much is going to cost to get the project, to start off the project, less the cost, and then take out the depreciation, and then take the initial cost minus the future cost or the future investment or whatever we're going to make in the future, and then the difference between the two is what is going to determine if the project is going to be profitable or not. And so simple straight line depreciation is just basically you take your cost less less any future expenses divided by the number of years. And so basically I think it's the cost less what the value of the asset at the end of the investment is, less divided by how long you're going to have the investment. And so for this case, the depreciation is going to be the asset, the fixed asset, which is 1.836, which is how much it's going to cost to get the asset, 1.86, less how much it's going to be worth at the end of the project, which the problem says is going to be worthless. So it's going to be less minus 0 divided by 2 years, which is how long the project is going to be. So with all said and done, you come up with an OCF, which is the operating cash flow for this particular problem is $957,780. And so for us to solve the net present value, we have to figure out, so we are going to put in, it's going to cost us $1.836 million to get into this project. And at the end of the project, we're going to be making $957,000. And so for us to relate, because if we just take the initial cost less the $957,000 we're going to make at the end, it's like we're trying to compare apples to oranges. And so we have to use the present value initial factor to bring that future value to a present value. And so when you use the table and look up the present value initial factor for 9%, and 2 years, I think is like 1.7 something times the 957, and then you add that back to the minus 1836, you come up with a negative 151,158. And so that's how much this project is worth today, the present value of this project. And so because it's a negative, we were asked to either accept it or reject it. We're rejected because we're already in the hole. if that makes any sense. And so that's the end of this problem, and on to the next one. Thank you.